You know, in 2025, the entire world of finance quietly, almost secretly, rewired itself. And it was all because of this once niche digital asset called a stablecoin. It went from being a risky experiment to a core part of how money moves around the globe. So how on earth did that happen so fast? Well, that's exactly what we're going to break down today. This quote from Fintech Weekly just absolutely nails it. See, you gotta forget the idea of some chaotic crypto revolution. What happened in 2025 was way more deliberate. Think of it like a controlled demolition and reconstruction of our financial plumbing, with everyone, and I mean everyone, regulators, banks, fintechs, all standing at the same drawing board. So how did we get here? It's really a six-part story. We're going to start with the market's raw, chaotic energy, then see how a single law completely changed the game, sparking a kind of banking gold rush. Then we'll hop across the Atlantic to see Europe's response, watch these ideas become real-world tools, and finally, take a look at what this new financial infrastructure actually looks like. Okay, so you can really think of 2025 as a series of dominoes just waiting to fall. The year kicks off with a total market frenzy. Then, bam, in late May, the US government pushes over the first big one, the Genius Act. That immediately knocks over the next one, with the big banks scrambling to form a consortium. By October, you've got giants like Visa setting up their own dominoes, all while Europe's own framework is clicking into place. Each piece just perfectly set the next one in motion. All right, so let's rewind the clock to the very beginning of 2025. The stablecoin market was, still a little shaky, still trying to shake off the ghosts of past collapses, but you could just feel this incredible raw energy building up. Everybody knew something big was about to give. And when I say energy, I mean money. A lot of money. We're talking monthly transaction volumes that blew past $700 billion. This was way beyond a handful of crypto enthusiasts anymore. Millions of new users were pouring in. This was the start of something on an industrial scale. And this created this fascinating split in the market. On one side, you had the fintechs, right? Moving at rocket speed, going all in on stablecoins for literally everything. But on the other side, the big traditional banks, moving super cautiously, basically just waiting for a green light from regulators. And that tension right there, that defined the entire first half of the year. And then the green light came. This was it. This was the single biggest turning point of the entire year, the moment Washington finally stepped in and drew a clear line in the sand. In late May, the U.S. passed what they called the Government-Endorsed Neutral Innovation for the U.S. Act, or, the Genius Act. Don't let the kind of goofy name fool you. This was not just another bill. This was the starting gun for the entire race. So what did it actually do? Well, think of it like building 4 giant pillars for a new financial temple. First, it clearly defined who could issue stablecoins. Second, it forced them to prove, transparently, that they had the money to back them up. Third, it added new consumer protections. And finally, it created a clear oversight body. Suddenly, the Wild West had a sheriff. And this quote just perfectly captures that massive 180-degree turn. The very same policymakers who once dismissed crypto as a distraction were now actively building frameworks around it. Washington finally understood that to keep the dollar dominant in a digital world, it needed a regulated digital version. Just like that, stablecoins got promoted to instruments of national economic strategy. So with that new rulebook in hand, the floodgates didn't just open, they completely burst. Now let's look at how the institutions that were sitting on the sidelines just months before suddenly decided to jump right into the arena. I mean, you have to love the irony here, right? The very same banks that had spent years and years issuing these dire warnings about crypto volatility were now, almost overnight, designing their own digital tokens. It just goes to show you the incredible power of a clear set of rules. And they didn't go it alone either. The Big Four, we're talking JP Morgan, Bank of America, Citi, and Wells Fargo, they all teamed up. This wasn't about ego, this was pure survival. They were losing ground fast to the fintechs and decided the only way to fight back was to build a shared, fully backed token. Their goal wasn't to create some new currency, but to build a better digital version of the one we already have. And, this wasn't just an American story. At the exact same time, Europe was making its own massive moves, creating this powerful transatlantic alignment that would really shape the future of digital finance for good. So, Europe's answer was MiCAR, the Markets in Crypto Assets Regulation, and this was a huge deal. Why? Because it created a single, unified rulebook for the entire continent, something that had never, ever existed before. Now, their reasons, as you can see here, were a little bit different. The US was basically playing offense, trying to project the dollar's power into the future. The EU, on the other hand, was playing defense, trying to prevent the Eurozone from fracturing into a bunch of different digital currencies. But here's the crazy part. They both landed in almost the exact same place, creating a harmonized set of rules across the Atlantic. For global finance, that was an absolute game changer.
Okay, so the rules are written, the big players are at the table. Now comes the real test, moving all of this from theory into practice. I mean, how does this stuff actually work in the real world?
Visa's pilot program from that time is the perfect example. So a business needs to send money overseas. But instead of going through the slow, clunky chain of intermediary banks, the settlement happens instantly, using stablecoins. And the result? A process that used to take days now takes just minutes. But look, for any of this to work, it had to be built on a rock-solid foundation. We're not talking about some speculative tech anymore. This required industrial-grade pillars: scalability, reliability, security, and constant monitoring. You could say all those years of fintech experimentation, well, they were just a dress rehearsal for this very moment. And so by the end of 2025, the financial world looked completely different. So let's just take a step back for a second and reflect on what this new financial infrastructure really means for all of us. If you remember one thing, just one thing from this entire story, please make it this quote right here. We're so used to thinking of regulation as a brake, something that slows things down. But in the story of 2025, it was the accelerator. Clear rules didn't stifle innovation. They unleashed it. So, what are the big takeaways from this whole whirlwind of a year? Well, first, clear rules brought everybody to the table. The banks, seeing fintechs eating their lunch in the payments business, finally jumped in. Sheer rivalry turned into collaboration. And maybe most importantly, our very idea of what stability even means evolved, from just a simple peg to the dollar to something much, much deeper. And that brings us to the final and maybe the most important lesson of all. Progress in finance is rarely a revolution. It's a revision. It's built one regulation, one pilot program, and one partnership at a time. It's not about wild disruption. It's about disciplined, deliberate engineering. Which, of course, leaves us with one huge, hanging question. If stablecoins are now a permanent part of the official infrastructure, and not just some temporary bridge, what gets rewired next? What other part of our financial world is about to be completely transformed?